all these wild conspiracy theories and stuff like this. And if we all buy silver, we can bankrupt JPMorgan.
Joining me today is Jeffrey Christian from the CPM Group. In this interview, we get into why silver is trading in the low $18 range, the JPMorgan spoofing scandal, and I finish the interview by asking Jeffrey, could we see a scenario with quantitative easing coupled with high interest rates? Jeffrey, thanks so much for joining us today.
Yeah, it's a good day to be with you, I guess.
So I was watching some of your content this morning, and I noticed that you spend quite a bit of time engaging with the comment section on your YouTube videos. And I find it kind of interesting because you're sort of in this precious metals world where there's a lot of sort of toxic people, and the ideas that tend to travel the furthest or get the most noise are often the most, how do we put it? Insane. Ridiculous. Everything's a product of manipulation. There's, a group of global elites that have put together this whole plan to control all of us. And the only way that we can go and defeat these global elites is to just go and buy as much silver as we can. At least that seems to be sort of the ideas that you often read on the internet. And I'm curious how you've been in the silver business for a long time, or the precious metals. How has it always been like this, or is this just sort of a product of kind of since like zero hedge came around?
I don't think it's zero hedge. The answer is yes. There have been conspiracy theories about gold and silver market manipulation and price suppression and price manipulation, going back to ancient Phoenicia. So there is a sector of the population that psychologically doesn't believe in Occam's razor, and anything that happens has to be the product of a conspiracy or something malevolent. And so there's always been a group of people who have believed that. Now, with silver, for a long period of time, we had fixed silver prices or managed silver prices, because from like the 1870s until 1960s, the U.S. Treasury was the buyer and seller of last resort of silver. But then after 1960s, the Treasury got out of the silver market, and you started seeing private investors being more active in it. And I guess with the circumstances surrounding the run-up in commodity prices, including silver in 1979, into 1980, there were some theories that came out. But with, that's silver, and I'll come back to silver in a second. But gold has always been much more overrun with people who believe in market manipulation and conspiracy theories. But now with silver, it was relatively less until the late 1980s. And in the late 1980s, there was a broker, we called them right shoe brokers in Southern Florida for Drexel Burnham, who tried to manipulate and corner the frozen and concentrated orange juice market. And the CFTC came down on him, and they came down on Drexel. Drexel paid a fine for non-supervision and fired the guy. And he went to the CFTC and said, I can tell you what Drexel's been doing to suppress the silver price if you're lenient with me in your penalties for what I did in orange juice. And the CFTC said, show us what you got. And if it's good, maybe we'll be lenient. He showed them what they had. They investigated Drexel's silver book. They found that what he said was totally not true. They found a couple matched trades, which actually run counter to his idea that they had this massive short position that they were suppressing the price. You do match trades to have a hedged book, or you did back then before other legal procedures were available. So they banned him for life. He then wrote letters to the Attorney General, the governor of Idaho, the CEOs of the major silver mining companies at the time, saying, there's this grand conspiracy to suppress silver prices. And Drexel is at the center of it. Drexel went bust, so it was Merrill Lynch. Merrill Lynch got out of precious metals, so it was JPMorgan. And that's really where a lot of this came from. Now, in the mid-aughties, when Sprott was creating its physical silver ETF, or maybe not Sprott the company, but Sprott the man, or rather his daughter, started promoting the idea that there was no silver in Toronto, there was no silver in London, and they were paying people to say stuff like that. And you can't really trust Scotiabank or HSBC or anybody else to be actually holding your metal. So you should take your metal out of there and put it into Sprott's physical silver ETF. And that revived this whole thing. So that's really the origin of it. I should say that we're speaking at the Silver Symposium, 30th, 31st of August in Spokane, and we're going to have an evening session. I'm giving a speech on the real silver market. We'll have an open forum question and answer period. But on Tuesday night, 30th of August in Spokane, we're going to have a special session where I will run through the evidence for and against silver conspiracy theories. And hopefully we'll have some very interesting questions and answers after that. Okay,
so we're on silver now. In your view, why is silver trading, the last time I checked was trading in the low $18 range. Why is it that silver's here?
Silver's there because that's a supply and demand situation, and again, there are people, well, it was $28 in the middle of 2020. Yes, but it was $15 at the beginning of 2020. So, silver had a run up starting in July of 2020, and it went from $15 to $28, $30. And there was a wave of investment demand. Go back to 2020, the pandemic, the global lockdown, the recession that came about because of the global lockdown, all kinds of weird things were going on. And the price, investors poured into gold and silver, and gold prices rose sharply and silver prices rose sharply to peaks in early August of 2020. And that brought in a lot of investors, and it also brought in a lot of these promoters with wild tales of drunkenness and misery. That's a Ray Davies lyric from the Kinks. All these wild conspiracy theories and stuff like this. And if we all buy silver, we can bankrupt JPMorgan. Actually, when you buy silver and you drive the price of silver up, banks that trade silver earn more money. So when Sprott did it, like around 2011 or whenever that was the period of time when JPMorgan earned more on its gold and silver trading book than ever before, because banks earn a percentage. They don't run unhedged books. They run hedged books, and they earn a percentage on the transactions. And if the price goes from $15 to $20, and you're making the same volume of transactions, you're making 25% more, 33% more trading profits as a financial intermediary. So it was just all nonsense. But, the prices come off because of several things. One is there's concern about a recession. The second thing is there's concern about reduced demand. Third thing is that investors have pulled back sharply from the amount of silver that they bought in the second half of 2020 and the first half of 2021, some because they don't think the price is going to rise, and some because they've become disenchanted because they had bought at $25, $28 an ounce, $30 an ounce, because somebody had told them it was going to 50 or 100 or 1,000, and it hasn't.
You brought up JPMorgan, so I got to ask you, there in the news today with, I guess that there's a trial going on right now with the DOJ and various former employees or people associated with JPMorgan involving racketeering and conspiracy. One of the things that came out just, I think, in the news this morning was that they had an ex-employee who said that they would spoof the market. How closely are you following this story?
I'm following it somewhat closely. Yeah. What's the question?
So what are your thoughts? Do you think that this could actually lead to a bigger story here, or do you think that this is just just a whole lot of nothing?
Well, I think that the most of the story and most of the revelations are already in the market. The CFTC, the SEC, the Fed, the OCC, a combination of groups went and studied JPMorgan. And they found that not just within gold and silver and not just within commodities, but across financial markets, mostly in the currency and interest rate markets, but also in the equity markets, as well as the commodities markets, that JPMorgan, in the words of the complaint against the bank itself, A, grossly undersupervised traders, and B, created an environment that encouraged or at least allowed spoofing across markets. And there were massive fines against JPMorgan, and they came under Fed surveillance, and they had to put in place all sorts of supervision and compliance issues. And about a year or so ago, actually, they were released from that oversight in a report where the federal authorities said, the JPMorgan has done an exemplary job of implementing oversight, compliance, and surveillance things. This is a rump thing, which is 3 guys now, and then there's a 4th person at JPMorgan who were actually involved in precious metals trading and have been accused of conspiring among themselves to spoof the market. And, so it's sort of like a postscript, if you will. JPMorgan has said, we did this, it's bad. And these are the actual people who were doing it in precious metals now brought to trial. And we'll see where the trial goes.
Okay, so let's talk about inflation. We got the big CPI print yesterday morning, 9.1%. The consensus estimates going in were 8.8%. Were you surprised by the 9.1% print, and do you think we've hit peak inflation here?
I think that it was a little bit higher than we thought. We figured it would be over 8.5%. So we were a little bit surprised. We were the month-to-month inflation actually was a little bit lower for the 3rd consecutive month. That suggests to us that, we may actually be peaking in our inflationary pressures, and that as the second half of this year unfolds, we may start to see lower prices. But the really worrisome thing in yesterday's CPI was that the price increases were across the board. There wasn't anything that didn't rise in prices. Now, you kind of expect that. If you go back a year ago to the second quarter of 2021, when inflation really started picking up, it was primarily energy and then food and used cars. Other things were actually lower inflation. So core inflation was relatively low, ex food and energy, with the one outlier of used vehicles. Now you've got every other sector of the economy saying we have to play catch up because our food costs have risen, our energy costs have risen, our transportation costs have risen. We know mining companies that can't find a pickup truck. They need pickup trucks for people to drive around the mine site. They can't find them. So you're finding that the rest of the economy is now playing catch up with food and energy. And that's probably going to persist for a while. We do think that we're probably seeing peak inflation in 2022 and that we'll see lower inflation. I'll add that, there's a lot of attention on the Fed. The Fed can try to combat inflation by raising interest rates and sucking money out of the economy. That reduces the inflationary pressures on the demand side of the market, or the demand side of the economy. But if you look at what's going on with inflation over the last 15 months or so, a lot of the inflationary pressures have been on the supply side and on fiscal stimulus. So it's not that the Fed's been supplying money, it's that the federal government, the Congress and the administration have been spending it like drunken sailors. And that is something that the Fed can't control, even with interest rates. Well, I guess they can control it with interest rates because they can bankrupt the government. But since the government is their sole customer, they probably wouldn't bankrupt them. But there's a lot of pressures on the supply side, and raising interest rates and sucking money out of the system doesn't quell inflationary pressures on the supply side of the economy. It actually worsens them because companies say, I'm facing higher interest rate costs. Money capital is harder to come by, so it makes it more difficult for me to expand my supply issues. And the cost of my money to do business to supply the demand side of the economy has gone up. I have to pass those costs on to my customers. So, there's only so much the Fed can do. And the Congress and administration don't seem to have any interest in doing anything about fiscal responsibility.
So you actually think that raising interest rates could make inflation worse?
Well, it will help the demand, but the initial factor is that it actually increases inflationary pressures on the supply side of the economy.
Yeah, that's something we don't really think about very much. Here in Canada, we raised rates 100 basis points yesterday. Nobody saw that coming. I was listening on a bunch of Twitter Spaces last night, and I don't know what it's like where you live, but here in the Toronto area, there's being a real estate agent or mortgage broker seems to be the hottest job, and they all seem to be on Twitter. And pretty much, I don't think it matters what point we're at in the economy. They're always giving advice to everybody: stay variable, don't go fixed. And I suppose that if we look at the yield curve, that might actually be reasonable advice. Certainly, what the bond market seems to think. Do you think that raising rates this aggressively something that they'll continue to do going into the rest of the year, or do you think that this was just sort of, let's just get it all done now, and then we can maybe do a pause by the end of the year?
Well, forget what I think. The CME has a futures contract that shows you what the market consensus is.
Yeah.
And the market consensus has shifting from 75 basis points to 100 basis points when the Fed meets later this month. But the forward curve in the CME interest rate expectations show that the market assumes that that's probably the peak increase in interest rates, and then it's maybe 75 basis points the next time, and then lower by the end of the year, and maybe that's the end of the increases in interest rates. And that happens to be our view too, but what we think doesn't count as much as what the market consensus thinks. So I think that that's where it's going. But again, the Fed manages short-term interest rates. Mortgages tend to be long-term interest rates. The advice of going variable instead of fixed is the same advice that caused all those people to go bankrupt and lose their houses in 2006 to 2009. So I think it's really wrong-headed to think that way. Because variable interest rates will kill you. If you have a fixed interest rate and it's fixed for 15 years or 30 years, and you can fit that into your budget, you're safe. I have a good friend who just bought a house. He paid for it in cash. He doesn't have to worry about what mortgage rates are. But if you have a variable rate, you are at the whim of shorter term interest rates, and you can really get a lot of financial damage and destruction if you're exposed to variable rates. So I'm not a mortgage broker, and that's probably why I would say that variable rates are bad, because mortgage brokers want to do the business, and their business is actually suffering. You're seeing, I don't know about Canada, I believe it's true in Canada, but in the United States, housing sales are falling, and they've been falling for several months now. The average price of a house is going up because rich people can still afford big houses with high prices, but smaller, less wealthy individuals have pulled back sharply from buying houses, and housing sales have actually fallen. So you're starting to see, mortgage providers and real estate agents and a lot of other people sweating because they lived through 2008, 2011. And the writing's on the wall that if they're not careful, they could do that again.
One last question for you. I'm sure you wake up every morning and you're reading a ton of media, trying to comprehend everything that's going on in the world. In terms of just commodities and ultimately where funds are flowing and just sort of supply and demand characteristics of everything, what are you watching right now in terms of what's going on in the world and ultimately how it's going to impact your investing strategy?
Oh, God. We watch everything. Yeah, I mean, literally everything. And you know,
is there anything though that you're kind of looking at and saying, okay, you know, like wheat shortages, the price of oil, what's happening right now with natural gas in Europe? Is there anything that you think is something that we should be following really closely?
Well, there are several things. One is not the price of oil, but the supply of oil. I mean, United States oil producers have sharply reduced their output. And that, you know, oil prices started rising in October, long before Russia invaded Ukraine. And anybody who says that oil prices rose because Russia invaded Ukraine shouldn't be president of the United States. You know, he should be in a retirement home someplace. But the supply of oil is important. Dollar and currency exchange rates are very important. What's going on in China politically, economically, financially, and internationally is very important. We're also spending a lot of time looking at esoteric corners of the debt market. Because if you go back, I mean, a lot of people focus on the Treasury and they have all these really crazy things like, oh, the Treasury could go bust and people could stop buying US Treasury bonds. Treasury bonds will be the last thing that people stop buying. If you go back to 2006, 2008, the crisis occurred in the collateralized mortgage obligation market, which I wound up spending a lot of time explaining what it was to people because no one knew about it, or very few people knew about it. It was an esoteric corner of the debt market that had been overtaken by crazy and inappropriate behavior based on greed on the part of everybody involved. And it blew up, spilled over into the broader interest rate market, which created the Great Recession and the global financial crisis. So we're spending a lot of time saying, what's that esoteric corner of the debt market that no one's paying attention to? They're all on the front porch with their guns, waiting for the revenues to come down the road. And the feds have come in the back door. You know, they're all watching the Treasury market. But the real problem is going to be that backdoor, esoteric, unknown piece of the debt market. One of the things that we've been paying a lot of attention to for years is the imbalance of equities and the supply and demand of equity derivatives. You know, you have enormous multiple of derivatives based on equity indices and equity markets. And it's terrible because, you know, and I remember back in 2000, we'd have these discussions with banks and international banking regulators and stuff. And the banking regulators would say, well, we're kind of worried about the imbalance between the leverage in the financial markets. And the banks would say, it's okay because it all nets out. And then somebody would say, it's okay if it all nets out simultaneously. But if there's a kink in the work, like one of those people in that chain of borrowings goes bankrupt and the bankruptcy court says, no one gets disbursement until we figure out whose money this really is, then all of a sudden it can't net out simultaneously and you have a problem. So we've been paying a lot of attention to the imbalance between equity markets and equity derivatives, because that's where a lot of the money has gone to, not just over the last 4 years, but over the last 14 years now.
And it seems like, just sort of watching some recent examples we saw with nickel on the London Metal Exchange, I think it was Shenzhen, they're called, was found tremendously short. And what did the London Metal Exchange do? They just canceled all the trades. Yeah. So I mean, that's sort of my assumption of what will happen if there's a blow up there. But there's a lot of different components to it, I suppose, that we actually got to look at. Jeffrey, thanks so much for hopping on here. For our audience that want to find more of your commentary and read about it or watch it, where can they go to?
Well, www.cpmgroup.com is our website. There's a lot of free reads there. There are also links to some of our videos. You can also go to YouTube. We've been doing 2 videos a week for a couple of years now. On a broad range of topics. A lot of them are precious metals, but a lot of them are macroeconomic and things like that. So you can go to YouTube and see a lot of our videos for free. You can go to our website and get a lot of our reads for free. And then you can also subscribe to some of our things, like we have a gold, silver, and platinum yearbooks. We'll be coming out with our 2022 platinum yearbook on the 26th of July. And then, as I said, we'll be participating in the Silver Symposium in Spokane, Washington at the end of August. And we're encouraging everybody to be there because it could be a very interesting time.
Right, well, thanks so much for hopping on here and doing this, Jeffrey. And I'm sure that there's going to be lots more action going on in the global economy. And we'd love to have you back on here sharing your thoughts as we continue to just follow what's happening in the world.
I've been involved in metals since 79 and commodities since 75. So there's a pretty good chance I'll still be around and I'll be available to talk some more.
Is this one of the most interesting times since you've been covering this stuff?
Yes. As I said to a client yesterday, these markets are keeping me young.
Yeah. It seems like we're watching real life economic experiments happen before our eyes, and I have basically no thoughts on where we go from here, other than I'm trying to keep up by learning as much as I can.
Well, so many things have changed. I mean, the developments in the way monetary policy changed 2008, 2009 in response to the global financial crisis. That changed a lot of relationships among markets, and people haven't realized it. And, I've been around since the 70s. And when I hear people comparing today to, say, 1980, this isn't 1980. It's a completely different economy, a completely different society, completely different world. Financial markets have been deregulated. There's been globalization, containerization of shipping. This is a completely different place. And anybody who says, well, from World War II to 2008, this was the relationship between interest rates and recession, says, okay, yeah, but what about 2008 forward? It's completely different.
You think we could see a scenario where we see quantitative easing with high interest rates?
Yes.
Yeah, that's sort of where I think we're heading. But again, I don't know. I'm not a macroeconomist, but Jeffrey, thanks so much for hopping on here. Really appreciate you taking the time to do this, and hopefully you'll come back on in the future.
I'll be around.
Awesome. Thanks. Guys, I'm so thankful that you're taking the time to watch this interview. But if you could do me a big favor, please hit that like button, subscribe, and ring that notification bell. It would be greatly appreciated.